Welcome back, accounting students. This is Mrs. Bloomquist. We are on lesson 4 of chapter 16. Remember, chapter 16 deals with financial statements and closing entries for a corporation. And lesson 4 today is dealing with recording the closing entries for the income statement accounts. And so just, as a reminder that we did look at temporary and permanent accounts in chapter 8 when we were looking through the closing entries for a sole proprietorship, and we want to just really remember back to those income summary accounts and what we did previously. It's going to really help us. So the objective for this lesson is to prepare the closing entries, and just as you know, we take information from the adjusted trial balance and we go ahead and prepare some closing entries for things like revenue and expense accounts. And the closing entries close out net income and the temporary equity accounts that are, again, similar to what we saw in the sole proprietorship, but we want to remember that a corporation records 4 closing entries. And so there are some differences to that sole proprietorship, but this process should hopefully feel very familiar. We're getting to the end of that accounting cycle. So the 4 closing entries that we want to be thinking about, we have a closing entry for income statement accounts that have a credit balance, a closing entry for income statement accounts with a debit balance, a closing entry that we're going to use to record either net income or net loss in the retained earnings account, and then close that income summary account. And then finally, we need a closing entry for the dividends account. Now, I'm going to direct you to that T account for the income summary information, and this is on page 494, and it's probably just a good idea to review this T account as it deals with the debit and credit from that income summary, where the expenses are, where the revenue would be, and then if there is a credit balance, now we have net income for our business. Okay. So the closing entries for accounts with credit balances, as we look at sales, you can see the closing entry is going to be over on the debit side because we had a balance on the credit side, so that the new balance for sales zeroes out. Okay, so we start with the 0 balance then in our next accounting cycle. Our interest expense puts a closing entry on the credit side, okay? And we made an entry for merchandise inventory. Okay, so in our book now, we're looking at page 495, and so we're doing the closing entry for accounts that have credit balances. So what we're looking at then is that within our general journal, we're going to go ahead and do some closing entries. And you can see we want to make sure we include a heading so that within our general journal we know what we're posting as closing entries. We identify the date is the year end. And then we go ahead and evaluate the accounts on the adjusted trial balance that have these credit balances. So that's how we know that we will be using a debit to close. So you can see sales, where I have a credit balance, I'm going to post then this debit as a closing entry to close out the account. Same with my purchases discount, because that's a credit balance, my purchases, returns, and allowances, and my interest income. They're credits on the adjusted trial balance, so we would use a debit entry to close. Then we're going to go ahead and post the credits to close from the accounts, the income statement accounts, that now are listed with a debit. So if they have a debit balance, then obviously we're going to do a credit to close out the accounts. All right, so summary of closing entry for income statement accounts that have the debit balances. So what you just want to do is we're looking at purchases, and our purchases has a debit balance, so that means our closing entry is going to be a credit, and then on that income summary we would be looking at a closing as a credit, okay? And you always want to remember that in order to zero out an account, the debits and the credits have to equal 0. Once you have a debit and a credit, it will zero out, and then your closing entry zeroes your account. All right, so closing entry to record net income, and this is where we now are able to look at, hey, did our business have any income that we can report? So as we're looking at that net income piece, sorry, I'm trying not to cough in your ear again, so we'll just try to get through it. So the closing entry to record net income, what we're looking at then is on the 31st, we have the debit to income summary, and then we're going to go ahead and credit retained earnings. So we're debiting on the income summary piece. Here's income summary. So we're going to go ahead and debit the income summary to close, and then we're crediting the retained earnings, and that's where the credit is. And that this debit to income summary goes ahead and closes out that income summary account. So we need to then do a closing entry for dividends. And you can see that again on the 31st, we are going to debit our retained earnings, and then we're going to credit dividends. So you can see that we have this, this $15,000 debit right here to retained earnings, and then we are going to credit dividends right here. So wait, closing, right? All right, so completed closing entries for a corporation recorded in the journal. And again, if your eyes are bad like my eyes, you want to look at this on page 499, because this fills up almost the entire page on 499 as we're looking at this general journal that has all of the closing entries. So right up here at the top, you can see we're looking at closing entries and what we have going on in the different accounts. Okay, now something that you want to keep in mind is that how you would close out for a net loss is backwards from how you would close out when you actually make money. So you want to be thinking about that piece of the puzzle. You also just want to remember that some of the accounts that we're working with are temporary, and so we need to close them out because they're not permanent accounts. So where do we find the information to do the closing entries for revenue, costs, and expenses? Again, adjusted trial balance. The name of the temporary account that we use to summarize the closing entries for revenue, costs, and expenses, that's our income summary. And isn't that nice that it's those two quick little questions? You want to be thinking about then why the income summary doesn't appear on any financial statements. And the reason for that is it's a temporary account and we only use it to close out other temporary accounts. So it never shows up on our financial statements. And then finally, why wouldn't the income summary account be used more frequently? Why don't we use it all the time? And the reality is we only use it at the end of the fiscal period. So by closing out revenue and expenses at the end of a fiscal period, then we have access to a clear line of data. If you try to do it more often than that, then, quite honestly, the business would not have access to data that it would use to determine if it has a net loss or a net gain for a fiscal period. So you want to only be closing out those accounts, that income summary account, at the end of a fiscal period. Okay, so from here, you want to go ahead, do the form online, the work together and on your own, and touch base with me if you have any questions. Otherwise, you can move on to section 16-5.